Question 1. The efficiency study reveals that a significant number of property casualty insurance claims are being contested due to disputes over policy exclusions. In one instance, a policyholder experienced damage from a flood that was attributed to an unusually high tide exacerbated by a storm surge. The policy contains an exclusion for flood, surface water, waves, tidal water, overflow of a body of water, or spray from any of these, whether driven by wind or not. Which of the following approaches best aligns with regulatory compliance and professional practice when determining coverage for this loss? Option A. Interpret the exclusion narrowly, focusing on whether the overflow of a body of water was the sole and direct cause, or if the storm surge introduced an element of wind-driven water that might fall outside the exclusion's intent. Option B. Advise the policyholder that while the exclusion is broad, the insurer will consider the specific circumstances of the storm surge and its interaction with the tide to determine if any part of the loss is covered, based on a principle of equitable relief. Option C. Investigate whether the storm surge was the primary cause of the water ingress, and if the water could be classified as surface water due to its unusual inundation, potentially overriding the exclusion. Option D. Deny the claim outright, as the exclusion clearly mentions tidal water and overflow of a body of water, which are directly implicated by the storm surge and high tide. Correct answer is D. Deny the claim outright, as the exclusion clearly mentions tidal water and overflow of a body of water, which are directly implicated by the storm surge and high tide. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of policy exclusions and their application to specific client circumstances, moving beyond a superficial reading of policy documents. The challenge lies in accurately interpreting the intent of the exclusion and applying it fairly, ensuring the client is neither overinsured nor underinsured due to a misunderstanding of coverage limitations. Careful judgment is required to balance the insurer's need to define risk with the policyholder's expectation of coverage for foreseeable events. The correct approach involves a thorough review of the specific policy wording, relevant case law, and any applicable regulatory guidance concerning the interpretation of exclusions. This approach is right because it prioritizes adherence to the contractual terms of the insurance policy and the governing regulatory framework. Insurers are bound by the policy contract, and exclusions must be applied as written, unless there is ambiguity that, under regulatory principles, should be construed in favor of the insured. Furthermore, regulatory bodies often provide guidelines on how exclusions should be communicated and applied to ensure consumer protection and fair dealing. An incorrect approach that relies solely on a general understanding of common exclusions without consulting the specific policy wording is professionally unacceptable. This fails to acknowledge the unique nature of each insurance contract and the potential for variations in exclusion clauses. It can lead to misinterpretations of coverage and potentially result in the insurer denying a valid claim or, conversely, covering a loss that was explicitly excluded, leading to financial strain for the insurer and potential regulatory scrutiny for unfair claims practices. Another incorrect approach is to interpret exclusions broadly to minimize insurer liability, even when the loss arguably falls within the spirit of the coverage. This violates the principle of utmost good faith and can lead to allegations of bad faith claims handling. Regulators expect insurers to act fairly and reasonably. An overly aggressive interpretation of exclusions can be seen as a failure to do so, potentially resulting in penalties and reputational damage. A third incorrect approach is to assume that because a peril is generally excluded in many policies, it is automatically excluded in this specific policy without verification. This demonstrates a lack of due diligence and a failure to uphold the contractual obligations owed to the policyholder. Each policy is a distinct contract, and its specific terms, including exclusions, must be individually assessed. The professional decision-making process for similar situations should involve 1. A meticulous review of the specific policy document, paying close attention to the precise language of any exclusion clauses. 2. Researching relevant case, law, and regulatory interpretations that may shed light on the application of similar exclusions. 3. Consulting with underwriting or legal departments if there is any ambiguity or uncertainty regarding the interpretation or application of an exclusion. 4. Communicating clearly and transparently with the policyholder about the nature of any exclusions and their potential impact on coverage. Question 2. The control framework reveals a client seeking homeowners insurance who is confused by the terms named peril and all-risk coverage. The client expresses a desire for the best possible protection, but is also budget-conscious. The insurance professional must determine the most appropriate way to advise this client to ensure they understand their options and make an informed decision that balances comprehensive coverage with cost-effectiveness. Adhering to regulatory guidelines for consumer advice. Option A. Recommend an all-risk open peril policy, emphasizing its broader coverage, and explain that it is generally superior for best possible protection. Option B. Explain the fundamental difference between named peril and all-risk policies, detailing the types of perils covered and excluded for each, and then conduct a risk assessment with the client to determine which best fits their specific needs and budget. Option C. Advise the client that named peril policies are typically less expensive and therefore a better option for budget-conscious individuals, without delving into the specifics of what perils are covered. Option D. Provide the client with the policy documents for both named peril and all-risk options, and instruct them to read through them to make their own decision. The correct answer is A. Recommend an all-risk open peril policy, emphasizing its broader coverage, and explain that it is generally superior for best possible protection. Explanation. The control framework reveals a common challenge in personal risk management, accurately advising clients on the nuances of homeowners' insurance coverage, specifically the distinction between named peril and all-risk open peril policies. This scenario is professionally challenging because clients often have a limited understanding of insurance terminology and may assume broader coverage than they actually possess. The onus is on the insurance professional to ensure the client makes an informed decision that aligns with their risk tolerance and financial capacity, avoiding potential underinsurance or overpayment for unnecessary coverage. The correct approach involves clearly explaining to the client that a named peril policy only covers losses from the specific perils listed in the policy, while an all-risk open peril policy covers losses from all perils except those specifically excluded. The professional must then guide the client through a risk assessment to determine which type of coverage best suits their needs, considering factors like the likelihood of specific perils in their geographic area and the potential financial impact of uncovered losses. This aligns with regulatory requirements for fair dealing and suitability, ensuring the client's best interests are prioritized. Ethical obligations mandate transparency and a fiduciary duty to provide accurate and understandable advice. An incorrect approach would be to assume the client understands the difference without explicit explanation, or to recommend an all-risk policy without a thorough assessment of the client's needs and budget, potentially leading to them paying for coverage they do not require or cannot afford. This failure to adequately inform and assess suitability violates regulatory principles of consumer protection and ethical standards of professional conduct. Another incorrect approach is to only highlight the broader coverage of an all-risk policy without clearly articulating the exclusions, which can lead to a false sense of complete security and subsequent disappointment when a claim is denied due to an excluded peril. This misrepresentation, even if unintentional, can have significant financial consequences for the client and damage the professional's reputation and license. Professionals should adopt a decision-making framework that prioritizes client education and needs assessment. This involves actively listening to the client's concerns, using clear and simple language to explain policy types and their implications, and conducting a comprehensive risk analysis. The goal is to empower the client to make an informed choice, rather than simply selling a product. Regular review of policy coverage and client circumstances is also crucial to ensure ongoing suitability. Question 3. Regulatory review indicates that clients seeking personal risk management advice may also be experiencing challenges with debt management, impacting their ability to maintain insurance coverage. Considering the scope of practice for a personal lines insurance professional, which of the following strategies for reducing and managing debt is most appropriate for an insurance professional to discuss with a client? Option A. Recommending the client explore aggressive investment vehicles to generate returns that can be used to pay down debt quickly. Option B. Discussing the benefits of creating a budget to track income and expenses, identifying areas where spending can be reduced to free up funds for debt repayment and insurance premiums. Option C. Suggesting the client take out a high-interest personal loan to pay off all other outstanding debts, thereby simplifying their payment schedule. Option D. Advising the client to consolidate all existing debts into a single, new loan without a detailed assessment of the client's financial situation. The correct answer is B. Discussing the benefits of creating a budget to track income and expenses, identifying areas where spending can be reduced to free up funds for debt repayment and insurance premiums. Explanation. This scenario is professionally challenging because it requires an insurance professional to provide advice on debt management strategies, which can extend beyond the typical scope of insurance product sales. The professional must navigate the ethical boundaries of providing financial guidance while remaining within their regulatory purview and expertise. Careful judgment is required to ensure that any advice given is appropriate, compliant, and in the client's best interest, without straying into unlicensed financial advisory services. The correct approach involves recommending strategies that directly relate to the client's ability to manage their financial obligations, thereby improving their capacity to afford and maintain insurance coverage. This includes suggesting debt reduction methods that free up disposable income. From a regulatory and ethical standpoint, this aligns with the principle of acting in the client's best interest. By helping a client manage their debt more effectively, the professional is indirectly assisting them in maintaining financial stability, which is crucial for long-term insurance policy adherence. This proactive approach demonstrates a commitment to the client's overall financial well-being, which is a cornerstone of responsible insurance practice. An incorrect approach would be to recommend aggressive investment strategies for debt repayment. This is professionally unacceptable because it ventures into the realm of investment advice, which typically requires specific licensing and expertise beyond that of a property casualty insurance professional. Such advice could expose the client to undue risk and the professional to regulatory sanctions for operating outside their scope of authority. Another incorrect approach is to suggest the client consolidate all their debts into a single, large loan without considering the client's overall financial picture or the terms of such a loan. This is problematic as it may not be a suitable solution for all individuals and could lead to unforeseen financial complications if not properly assessed. The professional is not equipped to provide comprehensive debt consolidation advice without a thorough understanding of the client's entire financial situation and the specific loan products available, which falls outside the scope of property casualty insurance. A further incorrect approach is to advise the client to prioritize paying off high-interest credit card debt by taking out a secured loan against their home. While this might seem like a debt reduction strategy, it significantly increases the client's risk by leveraging their primary residence. Without a comprehensive understanding of the client's risk tolerance, income stability, and the terms of the secured loan, this advice could lead to severe financial distress, including the potential loss of their home. This is a form of financial advice that requires a deeper level of financial planning expertise than typically possessed by a property casualty insurance professional. The professional decision-making process for similar situations should involve a clear understanding of the client's immediate needs and how they relate to their insurance coverage. The professional should focus on strategies that enhance the client's ability to afford and maintain their insurance policies. If a client's debt management issues are complex or require specialized financial advice, the professional should ethically and responsibly refer the client to a qualified and licensed financial advisor or debt counselor, rather than attempting to provide such advice themselves. This ensures the client receives appropriate guidance and protects the professional from regulatory and ethical breaches. Question 4. The risk matrix shows a moderate likelihood of hail damage and a low likelihood of vehicle theft in the client's area. The client is inquiring about their auto insurance policy and asks, if my car is damaged by hail, or if it gets stolen, or if someone vandalizes it, will my insurance cover that? Option A. Damage from hail, theft, and vandalism is covered under the collision portion of an auto insurance policy. Option B. Damage from hail, theft, and vandalism is not covered by standard auto insurance policies. Option C. Damage from hail, theft, and vandalism is typically covered under the comprehensive portion of an auto insurance policy. Option D. All damage to the vehicle is covered by the auto insurance policy, regardless of the cause. The correct answer is C. Damage from hail, theft, and vandalism is typically covered under the comprehensive portion of an auto insurance policy. Explanation. This scenario presents a professional challenge because it requires an insurance professional to accurately assess and explain the scope of comprehensive coverage, specifically distinguishing it from collision coverage, to a client who may have a limited understanding of insurance policy details. The client's perception of damage to their vehicle could broadly encompass various causes, necessitating a clear explanation of what perils are covered under comprehensive versus other types of coverage. Careful judgment is required to ensure the client is fully informed and that their expectations align with their policy's terms and conditions, preventing potential disputes or dissatisfaction later. The correct approach involves accurately identifying that damage from perils such as hail, theft, and vandalism falls under the comprehensive coverage section of an auto insurance policy. This approach is correct because it directly addresses the client's query by correctly categorizing the specified causes of damage. Regulatory frameworks for insurance, such as those enforced by state departments of insurance in the U.S., mandate that insurers and their representatives provide clear and accurate information about policy coverage. Ethical obligations further require agents and brokers to act in the best interest of their clients, which includes providing truthful and understandable explanations of policy benefits and limitations. This ensures the client makes informed decisions about their insurance needs and understands what their policy will and will not cover. An incorrect approach would be to suggest that damage from hail, theft, or vandalism is covered under collision coverage. This is a regulatory and ethical failure, because collision coverage specifically pertains to damage resulting from a collision with another vehicle or object, or from overturning. Misrepresenting this would violate the principle of accurate disclosure, potentially leading the client to believe they have coverage they do not, or to misunderstand the purpose of their comprehensive coverage. Another incorrect approach would be to state that such damage is not covered by the policy at all, without further clarification. This is a failure to provide complete and accurate information. While the client might not have collision coverage, comprehensive coverage is designed precisely for these types of non-collision related damages. Failing to mention comprehensive coverage would be a dereliction of duty to inform the client of available benefits under their policy. A third incorrect approach would be to broadly state that all damage to the vehicle is covered, without specifying the type of coverage. This is misleading and inaccurate. Insurance policies are structured with specific coverages for specific perils. Such a vague statement fails to educate the client on the nuances of their policy and could lead to misunderstandings when a claim arises, as coverage is not universal for all types of damage. The professional decision-making process for similar situations should involve 1. Actively listening to the client's concern to fully understand their situation and question. 2. Accessing and accurately interpreting the relevant policy provisions, specifically the definitions and exclusions for comprehensive, collision, and other relevant coverages. 3. Clearly and concisely explaining the applicable coverage to the client, using plain language and avoiding jargon. 4. Confirming the client's understanding and offering further clarification if needed. This process ensures compliance with regulatory requirements for fair dealing and accurate representation, while upholding ethical standards of client service and transparency. Question 5. Compliance review shows that an insurance agent, when advising a client on selecting a life insurance policy, primarily focused on the insurer's recent profit margins and dividend payout history, while giving minimal consideration to the insurer's solvency ratios and its ability to meet long-term claims obligations. The agent stated that high profits and consistent dividends indicated a strong and reliable company. What is the most appropriate professional judgment regarding the agent's approach to evaluating the insurer's financial health for client advice? Option A. The agent should have prioritized an assessment of the insurer's solvency and liquidity ratios, as these are more direct indicators of its ability to meet long-term policyholder obligations, alongside profitability. Option B. The agent's approach is acceptable as long as the insurer has a good credit rating, as this supersedes the need to analyze specific financial ratios. Option C. The agent's reliance on dividend history is a strong predictor of future financial stability, making it a primary factor in client advice. Option D. The agent's focus on profitability and dividends is a sufficient indicator of an insurer's financial strength and reliability for client recommendations. The correct answer is D. The agent's focus on profitability and dividends is a sufficient indicator of an insurer's financial strength and reliability for client recommendations. Explanation: this scenario is professionally challenging because it requires the insurance agent to interpret financial information beyond simple calculations and apply it to client advice, which has significant regulatory implications. The agent must understand the underlying meaning of liquidity, solvency, and profitability ratios in the context of an insurance company's stability and its ability to meet policyholder obligations. Misinterpreting these ratios could lead to recommending unsuitable products or failing to adequately warn clients about potential risks, thereby breaching fiduciary duties and regulatory requirements. The correct approach involves the agent recognizing that while profitability ratios indicate the company's earning capacity, solvency ratios are paramount for assessing its long-term ability to pay claims and maintain operations. Liquidity ratios are also important for short-term obligations. A prudent advisor would prioritize solvency and liquidity as indicators of financial strength and stability, as these directly relate to the insurer's capacity to fulfill its promises to policyholders. This aligns with regulatory frameworks that emphasize the financial soundness of insurers to protect consumers. For example, regulations often require insurers to maintain certain solvency margins and adhere to risk-based capital requirements, underscoring the importance of these metrics. An incorrect approach would be to solely focus on profitability ratios. This fails to acknowledge that a highly profitable company might still be at risk if it lacks sufficient capital to cover its liabilities, especially during periods of high claims or economic downturns. This overlooks the fundamental regulatory concern for insurer solvency and the protection of policyholders' interests. Another incorrect approach would be to ignore all financial ratios and rely solely on the insurer's marketing materials or credit ratings. While credit ratings can be a useful indicator, they are not a substitute for understanding the company's internal financial health as reflected in its ratios. Marketing materials are inherently biased and not a reliable source for objective financial assessment. This approach neglects the agent's responsibility to conduct due diligence and provide informed advice, potentially violating regulations that mandate a certain level of professional care and knowledge. The professional decision-making process for similar situations should involve a multifaceted analysis of an insurer's financial health. Professionals must move beyond surface-level metrics and understand the interplay between liquidity, solvency, and profitability. They should consult regulatory filings, industry analyses, and internal financial statements to form a comprehensive view. When advising clients, the focus should always be on the insurer's ability to meet its long-term obligations, with solvency and liquidity being key indicators of this capacity. This proactive and analytical approach ensures compliance with consumer protection laws and ethical standards. Question 6. Quality control measures reveal that an insurance company is experiencing significant financial strain due to the accumulation of numerous small, individual property damage claims arising from a widespread, low-severity weather event. The company's existing primary insurance policies are designed to cover individual claims, but the sheer volume of these small payouts is depleting its reserves faster than anticipated. The underwriting team is exploring options to transfer this aggregate risk to a reinsurer. Which type of reinsurance would be most appropriate for the insurer to consider in this specific situation to manage the financial impact of this accumulation of small claims? Option A, treaty reinsurance. Option B, excess of loss reinsurance. Option C, proportional reinsurance. Option D, facultative reinsurance. The correct answer is D, facultative reinsurance. Explanation: scenario analysis. This scenario presents a professional challenge because it requires an insurance underwriter to distinguish between different types of reinsurance and their appropriate application in managing an insurer's risk exposure. Misunderstanding or misapplying reinsurance can lead to inadequate risk transfer, financial instability for the insurer, and potential regulatory noncompliance. The underwriter must demonstrate a nuanced understanding of how reinsurance mechanisms function to protect against specific types of losses. Correct approach analysis. The correct approach involves identifying that the insurer is seeking protection against a large number of small, frequent claims that, in aggregate, could significantly impact its financial stability. This scenario is best addressed by facultative reinsurance, which allows the insurer to cede specific risks or a defined portion of its portfolio on a case-by-case basis. Facultative reinsurance provides flexibility and allows the insurer to tailor coverage to its specific needs, effectively transferring the risk of accumulation of small losses. This aligns with the purpose of reinsurance as a risk management tool to protect the insurer's solvency and capacity. Incorrect approach is analysis. One incorrect approach is to suggest treaty reinsurance. Treaty reinsurance is typically designed to cover a class of business or a portfolio of risks automatically, rather than individual specific exposures. While it is a common form of reinsurance, it is less suited for the precise, risk-by-risk selection implied by the need to manage a large volume of small, disparate claims. It might not offer the granular control needed to address the specific accumulation risk described. Another incorrect approach is to propose excess of loss reinsurance. Excess of loss reinsurance protects the insurer against a single large loss exceeding a predetermined retention level. While it is a valid reinsurance type, it is primarily designed for catastrophic events or very large individual claims, not for the accumulation of numerous small claims. The scenario describes a different risk profile that excess of loss reinsurance is not optimally designed to mitigate. A further incorrect approach is to suggest proportional reinsurance without further qualification. While proportional reinsurance shares premiums and losses on a pro rata basis, it is a broad category. Without specifying the type, e.g., quota share or surplus share, it doesn't directly address the need to manage the accumulation of small, individual claims as effectively as facultative reinsurance, which allows for selective cession of these specific risks. Professional reasoning. Professionals in this situation should first clearly define the nature of the risk being managed. Is it a single large event or an accumulation of smaller events? Once the risk is understood, they should then consider the available reinsurance structures and their primary purposes. The decision should be guided by which reinsurance type most effectively and efficiently transfers the identified risk, ensuring the insurer's financial health and compliance with its risk management framework. This involves a thorough understanding of the insurer's specific needs and the capabilities of different reinsurance products. Question 7. Research into the process of handling a property insurance claim reveals a situation where a homeowner's dwelling sustained significant fire damage. The claims handler has received an initial estimate of the repair costs from a contractor engaged by the policyholder, which appears to be within the policy's dwelling coverage limit. The claims handler must decide on the next steps to ensure a fair and compliant claim settlement. Which of the following approaches best reflects the required regulatory framework and professional standards for handling this property insurance claim? Option A. Advise the policyholder that the claim is complex and will require an extended review period without providing a clear timeline for investigation or decision. Option B. Conduct an independent appraisal of the damage and repair costs, compare it with the contractor's estimate, and then negotiate a settlement based on the insurer's assessment, while explaining the basis of the settlement to the policyholder. Option C. Offer a settlement based on the depreciated value of the damaged property, regardless of the current cost to repair or replace it with similar materials. Option D. Immediately approve the contractor's estimate and issue payment, as it is within the policy limit, and provided by the policyholder's chosen professional. The correct answer is D. Immediately approve the contractor's estimate and issue payment, as it is within the policy limit and provided by the policyholder's chosen professional. Explanation. This scenario is professionally challenging because it requires the claims handler to balance the insurer's obligation to settle claims fairly and promptly with the policyholder's right to a claim settlement that reflects the actual loss sustained. The claims handler must navigate potential conflicts of interest and ensure adherence to regulatory requirements designed to protect consumers. Careful judgment is required to interpret policy provisions, assess damages accurately, and communicate effectively with the insured. The correct approach involves a thorough investigation of the loss, a fair assessment of damages based on policy terms and market values, and a transparent explanation of the settlement offered to the policyholder. This aligns with the regulatory framework's emphasis on prompt, fair, and equitable claim settlements, preventing unfair claim settlement practices, and ensuring that policyholders receive the benefits to which they are entitled under the contract. Ethical considerations also mandate acting in good faith and with honesty. An incorrect approach that involves offering a settlement significantly below the estimated replacement cost without a clear, policy-based justification fails to meet the obligation of fair settlement. This could be considered an unfair claim settlement practice, potentially violating regulations that prohibit misrepresenting policy provisions or failing to act in good faith. Another incorrect approach, offering a settlement based on outdated or depreciated values that do not reflect current market conditions for comparable property, also violates the principle of fair settlement. This can lead to the policyholder being undercompensated for their loss, which is contrary to the purpose of insurance and regulatory oversight. A further incorrect approach, delaying the investigation and settlement process without reasonable justification, can also constitute an unfair claims settlement practice. Regulations typically require insurers to act with reasonable promptness in investigating claims and making decisions regarding coverage and payment. Unnecessary delays can cause significant hardship to the policyholder. The professional decision-making process for similar situations should involve 1. Understanding the policy contract thoroughly. 2. Conducting a comprehensive and objective investigation of the loss. 3. Accurately assessing damages using appropriate valuation methods and considering current market conditions. 4. Communicating clearly and transparently with the policyholder regarding the investigation, assessment, and settlement offer, including the basis for any deductions or limitations. 5. Adhering strictly to all applicable regulatory requirements and ethical guidelines concerning claim handling. Question 8. To address the challenge of a client expressing confidence in their current uninsured motorist coverage, believing it will fully cover any damages from an uninsured driver, what is the most appropriate course of action for a personal risk management professional? Option A. Recommend a significant increase in coverage without detailing the specific reasons or benefits, simply stating it's a good idea for better protection. Option B. Assure the client that their current coverage is adequate and that they have nothing to worry about, as coverage is designed to protect them. Option C. Advise the client that coverage is complex and suggest they research it themselves to understand its intricacies. Option D. Proactively explain the specific limits and conditions of the client's current coverage. Discuss the potential financial exposure if those limits are insufficient for bodily injury or property damage, and recommend an increase in coverage based on their risk profile and financial situation. The correct answer is D. Proactively explain the specific limits and conditions of the client's current coverage. Discuss the potential financial exposure if those limits are insufficient for bodily injury or property damage, and recommend an increase in coverage based on their risk profile and financial situation. Explanation. This scenario is professionally challenging because it requires an insurance agent to navigate a client's misunderstanding of their uninsured motorist coverage, which directly impacts the client's financial protection in a critical situation. The agent must not only clarify the policy's limitations, but also ensure the client understands the potential consequences of their current coverage level, all while maintaining professional integrity and adhering to regulatory disclosure requirements. The correct approach involves the agent proactively identifying the client's misconception about coverage and providing clear, accurate information about its scope and limitations. This includes explaining that coverage typically applies to bodily injury and sometimes property damage caused by drivers who are uninsured or underinsured, and that the coverage limits are determined by the policy purchased. The agent must then recommend an appropriate increase in coverage based on the client's risk profile and financial situation, ensuring the client is fully informed to make a sound decision. This aligns with regulatory obligations to provide accurate policy information and act in the client's best interest, preventing potential underinsurance and subsequent financial hardship. An incorrect approach would be to simply confirm the client's existing understanding without further clarification or recommendation. This fails to uphold the agent's duty to inform and advise, potentially leaving the client inadequately protected and exposed to significant financial risk in the event of an accident with an uninsured driver. This could be seen as a breach of professional responsibility and potentially violate regulations requiring agents to ensure clients understand their coverage. Another incorrect approach would be to downplay the importance of increasing coverage, perhaps due to a desire to avoid a lengthy explanation or to maintain a lower premium for the client without fully assessing the risks. This is ethically unsound and could lead to a failure to meet the client's actual insurance needs, exposing them to substantial financial loss. It also disregards the agent's fiduciary duty to recommend coverage that adequately protects the client. A third incorrect approach would be to recommend an increase in coverage without adequately explaining the rationale or the specific benefits of the increased limits. While increasing coverage is generally advisable, failing to educate the client about why it's necessary and what it covers leaves them vulnerable to future confusion and may not lead to a truly informed decision. This lack of transparency can erode client trust and may not fully satisfy regulatory requirements for clear and understandable policy explanations. Professionals should use a decision-making framework that prioritizes client education and informed consent. This involves 1. Active listening to understand the client's current perception and needs. 2. Accurate assessment of the client's risk exposure and current coverage adequacy. 3. Clear and transparent communication of policy details, limitations, and benefits. 4. Providing tailored recommendations based on the client's specific circumstances. 5. Documenting the advice provided and the client's decision. Question 9. Analysis of a client's post-total loss inquiry regarding their gap insurance coverage, where the client expresses confusion about the final payout amount relative to their outstanding loan balance, requires an insurance professional to adopt a specific communication strategy. Which of the following approaches best aligns with regulatory requirements for accurate disclosure and ethical client representation in this scenario? Option A. Explain that gap insurance covers the difference between the vehicle's actual cash value at the time of the loss and the outstanding loan balance, up to the policy's stated limits, and clarify that it does not cover amounts exceeding these limits or other non-covered charges. Option B. Inform the client that gap insurance is designed to cover the entire remaining loan balance, regardless of the vehicle's value or policy limitations. Option C. Advise the client that the insurance company will handle all calculations and that the loan company will be in contact regarding any remaining debt. Option D. Emphasize the benefits of gap insurance in paying off the loan without detailing specific coverage limitations or potential shortfalls. The correct answer is A. Explain that gap insurance covers the difference between the vehicle's actual cash value at the time of the loss and the outstanding loan balance, up to the policy's stated limits, and clarify that it does not cover amounts exceeding these limits or other non-covered charges. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an insurance professional to accurately assess a client's understanding of gap insurance and its limitations, particularly in the context of a total loss. The client's perception of coverage might be influenced by marketing or incomplete information, leading to potential dissatisfaction and regulatory complaints if expectations are not managed properly. The professional must navigate the client's emotional state following a vehicle loss while ensuring they grasp the policy's specifics. Correct approach analysis. The correct approach involves clearly and concisely explaining to the client that gap insurance covers the difference between the vehicle's actual cash value, ACV, at the time of the loss and the outstanding loan balance, asterisk up to the policy limits asterisk. This explanation should also explicitly state that it does not cover any remaining balance if the loan amount exceeds the vehicle's ACV plus the policy's coverage limit, nor does it cover items like late fees, extended warranties, or negative equity rolled into the loan unless specifically endorsed. This aligns with regulatory requirements for clear and accurate disclosure of policy terms and conditions, preventing misrepresentation and ensuring the client makes informed decisions. Ethically, it upholds the duty of care by providing transparent and complete information. Incorrect approaches analysis. One incorrect approach involves simply stating that gap insurance covers the rest of the loan. This is a misrepresentation because it implies full coverage of any remaining balance, ignoring policy limits and potential exclusions. This failure violates regulations requiring accurate policy explanations and can lead to accusations of deceptive practices. Another incorrect approach is to tell the client that the insurance company will figure it out, or it's handled by the loan company. This abdicates responsibility and fails to provide the client with the necessary information to understand their financial exposure. It demonstrates a lack of diligence and can result in the client being blindsided by unexpected costs, leading to regulatory scrutiny for failing to adequately advise the policyholder. A third incorrect approach is to focus solely on the positive aspects of gap insurance without mentioning its limitations or the factors that could result in a shortfall. This selective disclosure is misleading and can create unrealistic expectations. It breaches ethical obligations to be truthful and transparent and contravenes regulatory mandates against misrepresentation. Professional reasoning. Professionals should approach such situations by prioritizing clear, comprehensive, and accurate communication. This involves actively listening to the client's concerns, using plain language to explain policy provisions, and proactively addressing potential misunderstandings. A structured approach, starting with the client's immediate need, and then detailing the policy's specific application and limitations, is crucial. Professionals should always err on the side of over-explaining rather than under-explaining, ensuring the client fully comprehends what is and is not covered, thereby mitigating future disputes and upholding professional integrity. Question 10. The investigation demonstrates that a small bakery, Sweet Delights, is facing a lawsuit from a customer who claims to have suffered a severe allergic reaction after consuming a pastry containing nuts, despite the customer having informed the bakery staff of their nut allergy. Sweet Delights has a commercial general liability, CGL, policy. Which of the following actions best represents the appropriate response from the insurer regarding potential coverage for this claim? Option A. Immediately deny coverage, citing the policy exclusion for intentional acts as the customer's allergy was a known condition. Option B. Offer a partial settlement to the customer without a full investigation, assuming the bakery may have been negligent to avoid a protracted legal battle. Option C. Conduct a thorough investigation into the facts of the incident, including reviewing the bakery's food preparation procedures, ingredient sourcing, and staff training records, to determine if the claim falls within the CGL policy's insuring agreement for bodily injury and is not excluded. Option D. Advise the bakery to seek independent legal counsel and inform them that the policy likely does not cover claims related to food allergies due to the nature of the product. Correct answer is A. Immediately deny coverage, citing the policy exclusion for intentional acts as the customer's allergy was a known condition. Explanation. The investigation demonstrates a common challenge in business liability insurance, determining the scope of coverage when a business's operations lead to a third-party claim. This scenario is professionally challenging because it requires a nuanced understanding of policy language, the specific facts of the incident, and the relevant regulatory framework governing insurance contracts. Misinterpreting coverage can lead to significant financial losses for the business and potential regulatory scrutiny for the insurer or broker. Careful judgment is required to balance the insured's expectation of coverage with the insurer's contractual obligations. The correct approach involves a thorough review of the commercial general liability, CGL policy, specifically the insuring agreements, exclusions, and definitions, in conjunction with the details of the incident. This includes identifying whether the alleged harm falls within the definition of bodily injury or property damage, and whether any exclusions apply. The regulatory framework, such as state insurance laws and departmental regulations, mandates that insurers act in good faith and fair dealing, which includes providing coverage for claims that are legitimately covered by the policy. A proper assessment ensures compliance with these obligations and upholds the principle of indemnity. An incorrect approach would be to deny coverage solely based on a superficial understanding of the claim or a broad interpretation of an exclusion without a detailed factual investigation. This could violate the duty of good faith and fair dealing, potentially leading to claims of unfair claims settlement practices. Another incorrect approach is to assume coverage exists without a careful examination of the policy terms and conditions. This can create a false sense of security for the insured and lead to disputes when a claim is eventually denied. Furthermore, failing to consider relevant case, law, or regulatory interpretations of policy language can result in an incorrect coverage determination. Professionals should employ a systematic decision-making process that begins with a comprehensive understanding of the insured's business operations and the nature of the claim. This should be followed by a meticulous review of the applicable insurance policy, paying close attention to all relevant clauses, consulting with legal counsel, or claims specialists when complex coverage issues arise is also a critical step. Adherence to regulatory guidelines and ethical principles, such as transparency and fairness, should guide every decision throughout the claims handling process. Question 11. During the evaluation of a client's personal financial situation, which approach to establishing an emergency fund best aligns with the principles of sound personal risk management and prudent financial advice? Option A. Recommending the client save 3 to 6 months of essential living expenses in a readily accessible, low-risk savings account. Option B. Suggesting that credit cards and lines of credit are sufficient to cover unexpected expenses, negating the need for a dedicated emergency fund. Option C. advising the client to invest their entire emergency savings in a diversified portfolio of growth stocks for maximum potential returns. Option D, recommending an emergency fund amount based solely on a generic industry standard, without assessing the client's specific income stability and expense patterns. The correct answer is A, recommending the client save 3 to 6 months of essential living expenses in a readily accessible, low-risk savings account. Explanation: this scenario presents a professional challenge because establishing an emergency fund is a foundational element of personal financial well-being, directly impacting a client's ability to withstand unexpected financial shocks. The advisor must balance the immediate need for liquidity with the client's longer-term financial goals and risk tolerance. Careful judgment is required to tailor advice to the individual's specific circumstances, income stability, and existing financial commitments, ensuring the proposed emergency fund is both adequate and sustainable. The correct approach involves a comprehensive assessment of the client's essential monthly expenses, income stability, and potential for unexpected costs. It then guides the client in setting a realistic savings target, typically 3 to 6 months of essential living expenses, and identifying suitable, easily accessible, and low-risk savings vehicles. This aligns with the ethical duty of care to provide advice that is in the client's best interest, promoting financial resilience and preventing undue financial distress. Regulatory frameworks often emphasize the importance of sound financial planning and risk management, which includes advising on adequate emergency savings. An incorrect approach would be to recommend investing the entire emergency fund in volatile assets. This fails to meet the primary objective of an emergency fund, which is immediate accessibility and capital preservation. Such advice would expose the client to the risk of significant losses precisely when funds are needed most, potentially exacerbating financial hardship. This constitutes a failure to act in the client's best interest and a breach of the duty of care, as it prioritizes potential returns over the fundamental purpose of the emergency fund. Another incorrect approach is to suggest that an emergency fund is unnecessary if the client has access to credit cards or lines of credit. While these can be useful tools, they are not a substitute for an emergency fund. Relying solely on credit can lead to accumulating high-interest debt, which can be difficult to repay and significantly damage financial health. This approach neglects the principle of prudent financial management and fails to adequately prepare the client for unforeseen events, potentially leading to a worse financial outcome than having a dedicated emergency fund. A further incorrect approach is to recommend an emergency fund amount that is unrealistically high or low without considering the client's specific situation. An amount that is too high might tie up excessive capital that could be earning better returns elsewhere, hindering other financial goals. Conversely, an amount that is too low would fail to provide adequate protection against unexpected expenses, defeating the purpose of the fund. Both extremes demonstrate a lack of personalized advice and a failure to adequately assess the client's needs and capacity. The professional decision-making process for similar situations should involve a thorough client discovery process to understand their income, expenses, debts, assets, risk tolerance, and financial goals. This information should then be used to develop a personalized financial plan that includes a realistic and appropriate emergency fund strategy. The advisor must clearly explain the rationale behind the recommended emergency fund amount and its placement, ensuring the client understands its importance and how it contributes to their overall financial security. Ongoing review and adjustment of the emergency fund strategy should also be part of the advisory process. Question 12. The evaluation methodology shows that when a policyholder reports damage to a detached garage on their property, which is primarily used for storing personal vehicles and seasonal equipment, the insurance professional must accurately determine the appropriate coverage. Considering the standard homeowner's insurance policy structure, which of the following best describes the initial classification of the damage to the garage structure itself? Option A. The damage to the detached garage structure is primarily covered under coverage B, other structures. Option B. The damage to the detached garage structure is primarily covered under coverage D, loss of use. Option C. The damage to the detached garage structure is primarily covered under coverage C, personal property. Option D. The damage to the detached garage structure is primarily covered under coverage A, dwelling. The correct answer is A. The damage to the detached garage structure is primarily covered under coverage B, other structures. Explanation. The evaluation methodology shows that understanding the nuances of homeowners' insurance coverage is paramount for effective risk management. This scenario is professionally challenging because it requires the insurance professional to accurately distinguish between different coverage types and their application to specific property elements, especially when dealing with items that might be considered part of the dwelling versus separate structures or personal property. Misclassification can lead to underinsurance, disputes during claims, and a failure to meet client expectations, all of which have regulatory and ethical implications. The correct approach involves a thorough understanding of the definitions within the homeowner's policy, specifically Coverage A, dwelling, Coverage B, other structures, and Coverage C, personal property, as defined by standard insurance regulations and policy forms applicable to the exam's jurisdiction. This approach correctly identifies that a detached garage, even if used for personal storage, is typically classified as an other structure under Coverage B, separate from the main dwelling, Coverage A. Personal property, covered under Coverage C, refers to movable items within the dwelling or on the insured premises. Loss of use, Coverage D, addresses additional living expenses incurred due to the insured's inability to occupy the dwelling. Therefore, correctly allocating the loss to Coverage B is essential for accurate claims processing and policy fulfillment. An incorrect approach that classifies the detached garage as part of the dwelling, Coverage A, fails to adhere to the policy's structural definitions. This misinterpretation could lead to the application of different coverage limits or deductibles intended for the main residence, potentially resulting in an inadequate payout for the loss. Ethically, it misrepresents the policy's terms to the client. Another incorrect approach that categorizes the contents of the detached garage as personal property, Coverage C, overlooks the distinction between the structure itself and its contents. While the items stored within the garage are personal property, the damage to the garage structure itself falls under Coverage B. This error would result in the structure's damage being undervalued or improperly handled, potentially violating policy terms and leading to client dissatisfaction. A further incorrect approach that considers the damage to the detached garage as a loss of use, Coverage D, fundamentally misunderstands the purpose of Coverage D. Loss of use applies when the insured cannot live in their dwelling due to a covered loss. Damage to a detached structure, unless it directly prevents occupancy of the main dwelling, does not trigger loss of use coverage. This misapplication would incorrectly process a claim and fail to provide the appropriate coverage for the damaged structure. The professional decision-making process for similar situations should involve 1. Carefully reviewing the specific policy language and definitions for Coverage A, B, C, and D. 2. Understanding the physical characteristics and intended use of the damaged property in relation to these definitions. 3. Consulting relevant regulatory guidelines and industry best practices for property classification. 4. Communicating clearly with the client about the applicable coverages and the reasoning behind the classification. Question 13. Benchmark analysis indicates that clients are increasingly concerned about how their credit scores impact their personal risk management insurance premiums. An insurance advisor is approached by a client who wants to understand how to improve their creditworthiness, specifically to lower their insurance costs. The advisor needs to provide guidance that is both effective and compliant with all relevant regulations. Which of the following approaches best aligns with regulatory requirements and ethical best practices for an insurance advisor? Option A. Tell the client that credit scores have no impact on insurance premiums and that there is nothing they can do to influence their rates through their credit history. Option B. Advise the client to dispute every negative item on their credit report, regardless of its accuracy, to artificially inflate their credit score for insurance purposes. Option C. Suggest that the client focus on short-term credit score hacks that might temporarily boost their score, without necessarily addressing underlying financial habits. Option D. Explain that while credit information can influence premiums, the advisor can guide the client on legitimate strategies to improve their credit profile, such as consistent on-time payments and debt reduction, and inform them of their rights regarding credit reports, while also clarifying the permissible uses of credit information by insurers. The correct answer is D. Explain that while credit information can influence premiums, the advisor can guide the client on legitimate strategies to improve their credit profile, such as consistent on-time payments and debt reduction, and inform them of their rights regarding credit reports, while also clarifying the permissible uses of credit information by insurers. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an insurance advisor to balance the client's desire for lower premiums with the regulatory and ethical obligations to provide accurate and compliant advice. The advisor must understand how credit information is used in underwriting, the permissible uses of credit information, and the potential discriminatory implications if not handled correctly. Misinterpreting or misapplying these rules can lead to regulatory sanctions, reputational damage, and harm to the client. Correct approach analysis. The correct approach involves explaining to the client that while credit scores can influence insurance premiums in many jurisdictions, the use of credit information is strictly regulated. The advisor must clarify that insurers can only use credit-based insurance scores derived from specific permissible factors, and that these factors are designed to predict risk, not to discriminate unfairly. The advisor should also explain that the client has rights regarding their credit report, such as the right to obtain a free copy annually and to dispute inaccuracies. Furthermore, the advisor should guide the client on general strategies to improve their creditworthiness, such as paying bills on time, reducing debt, and avoiding opening too many new credit accounts, all of which can indirectly lead to better insurance rates over time by improving their credit profile. This approach is correct because it aligns with regulatory frameworks that permit the use of credit information for underwriting purposes while safeguarding consumer rights and preventing unfair discrimination. It educates the client about the process and empowers them to take legitimate steps to improve their financial standing, which in turn can benefit their insurance costs. Incorrect approaches analysis. One incorrect approach is to suggest that the client can game the system by temporarily improving their credit score through methods that are not sustainable or do not reflect true creditworthiness, or by focusing solely on cosmetic changes to their credit report without addressing underlying financial habits. This is ethically problematic as it may mislead the client into believing short-term fixes will yield long-term benefits and could potentially violate regulations if it involves misrepresentation or encourages actions that are not in the client's best long-term financial interest. Another incorrect approach is to dismiss the client's concern entirely and state that credit scores have no bearing on insurance premiums, or that there is nothing the client can do to influence their rates related to credit. This is incorrect because it demonstrates a lack of knowledge about common underwriting practices and regulatory allowances for using credit information in insurance pricing. It fails to provide the client with accurate information and helpful guidance, potentially leading to client dissatisfaction and a missed opportunity to offer valuable advice. A third incorrect approach is to advise the client to dispute all negative items on their credit report, regardless of their accuracy, in an attempt to artificially inflate their score. This is unethical and potentially illegal. It encourages dishonesty and undermines the integrity of the credit reporting system. Regulators strictly prohibit such actions, and insurers are permitted to use accurate credit information for underwriting. Professional reasoning. Professionals should adopt a decision-making framework that prioritizes transparency, accuracy, and client well-being within the bounds of regulatory compliance. This involves 1. Understanding the specific regulations governing the use of credit information in insurance underwriting within the relevant jurisdiction. 2. Clearly communicating to the client how credit information is used, the permissible factors, and the client's rights. 3. Providing accurate and actionable advice on legitimate methods for improving creditworthiness, emphasizing long-term financial health. 4. Avoiding any advice that could be construed as encouraging misrepresentation, dishonesty, or circumvention of regulatory requirements. 5. Documenting all advice provided to the client. Question 14. Comparative studies suggest that while standard homeowners insurance policies offer broad protection, certain catastrophic events are often excluded. When advising a client on their homeowner's policy, what is the most accurate and professionally responsible way to explain the coverage limitations regarding events like floods and earthquakes? Option A. Explain that standard policies cover most damage, but specific endorsements are available for perils like floods and earthquakes if the client wishes to purchase them. Option B. Advise the client that while their policy covers many things, it's best to assume that major events like floods and earthquakes will not be covered and to inquire about additional coverage options. Option C. Inform the client that floods and earthquakes are not covered by their current policy and that these are typically separate insurance products or endorsements that can be added. Option D. State that all natural disasters are excluded from standard homeowners policies, and the client should consider separate coverage for any such events. Correct answer is A. Explain that standard policies cover most damage, but specific endorsements are available for perils like floods and earthquakes if the client wishes to purchase them. Explanation. This scenario is professionally challenging because it requires the insurance professional to accurately identify and communicate policy limitations to a client, ensuring the client understands what is and is not covered. Misinterpreting or miscommunicating exclusions can lead to significant financial hardship for the policyholder and potential E&O claims against the agent or insurer. Careful judgment is required to balance the need for comprehensive coverage with the reality of policy limitations and the client's specific risk profile. The correct approach involves clearly distinguishing between perils that are typically covered by a standard homeowner's policy and those that are specifically excluded and often require separate endorsements or policies. This aligns with the regulatory requirement for transparency and accurate representation of insurance products. Professionals have a duty to ensure clients are fully informed about their coverage, including its limitations, to prevent misunderstandings and ensure appropriate risk management decisions are made. This proactive communication prevents future disputes and upholds the integrity of the insurance transaction. An incorrect approach that fails to differentiate between covered and excluded perils demonstrates a lack of understanding of fundamental policy structures and regulatory expectations. This can lead to a client believing they have coverage for events that are explicitly excluded, creating a false sense of security and potentially violating principles of fair dealing and accurate disclosure mandated by insurance regulations. Another incorrect approach that broadly states all natural disasters are excluded without qualification is also problematic. While some natural disasters are excluded, others, like windstorms or hail, are typically covered. This oversimplification is misleading and fails to provide the client with the nuanced information necessary to make informed decisions about their risk management strategy. It can also be seen as a failure to adequately explain the policy's terms and conditions. A third incorrect approach that focuses solely on the cost of additional coverage without explaining the specific nature of the exclusions is also professionally deficient. While cost is a factor, the primary responsibility is to educate the client on what their current policy does and does not cover. Omitting this fundamental explanation prioritizes a sales aspect over the client's need for clear and accurate information about their protection. The professional decision-making process for similar situations should involve a thorough review of the policy's declarations page and exclusions. The professional must then translate this technical information into clear, understandable language for the client, addressing their specific concerns and risk exposures. This includes proactively identifying potential gaps in coverage and discussing available options for addressing those gaps, such as endorsements or separate policies, while always emphasizing the importance of understanding the terms and conditions of any insurance product. Question 15. Governance review demonstrates that a client's current auto insurance policy has underinsured motorist (UM) coverage limits that may not adequately protect them against drivers with insufficient insurance. Which of the following approaches best addresses this potential exposure? Option A. Advise the client to rely on their existing UIM coverage, as it is generally sufficient for most accident scenarios. Option B. Review the client's current UIM coverage limits and recommend an increase if they are deemed insufficient based on prudent risk management principles and the potential for significant damages from an underinsured driver. Option C. Explain to the client that UIM coverage is primarily for hit-and-run situations and their current limits are likely adequate. Option D. Suggest the client purchase an umbrella liability policy to cover potential underinsured motorist claims. The correct answer is B. Review the client's current UIM coverage limits and recommend an increase if they are deemed insufficient based on prudent risk management principles and the potential for significant damages from an underinsured driver. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an insurance professional to navigate the complexities of underinsured motorist (UM) coverage, specifically when a client's existing policy limits may not adequately protect them against a driver with insufficient insurance. The challenge lies in proactively identifying potential gaps in coverage and providing advice that aligns with both the client's best interests and regulatory requirements, without overstepping professional boundaries or providing advice that could be misconstrued as legal counsel. The professional must balance the need for comprehensive risk management with the client's financial considerations and understanding of insurance products. Correct approach analysis. The correct approach involves a thorough review of the client's current auto insurance policy, specifically examining the UIM coverage limits. This approach is right because it directly addresses the core of the client's potential vulnerability. By comparing the client's UIM limits to the average liability limits carried by drivers in their operating area, or to a benchmark considered prudent for adequate protection, the professional can identify a potential shortfall. The subsequent recommendation to increase UIM coverage limits is a proactive risk management strategy that directly mitigates the identified exposure. This aligns with the ethical duty of care to advise clients on appropriate coverage levels to protect them from financial loss due to underinsured motorists, as implicitly supported by the principles of prudent insurance practice and consumer protection inherent in insurance regulations. Incorrect approaches analysis. Recommending the client simply rely on their current UIM coverage without any assessment of its adequacy fails to meet the professional standard of care. This approach neglects the fundamental purpose of UIM coverage, which is to protect the insured when the at-fault driver's liability limits are insufficient. It represents a failure to proactively identify and address a significant risk exposure, potentially leaving the client financially vulnerable. Suggesting the client purchase additional, unrelated insurance products like umbrella liability coverage as a primary solution for UIM protection is incorrect. While umbrella policies can provide broader coverage, they are typically excess coverage and may not directly address the specific scenario of an underinsured motorist claim as effectively as increasing UIM limits. This approach misdirects the client's focus and may not provide the most efficient or appropriate solution for the identified risk. Advising the client that UIM coverage is only relevant if they are involved in a hit-and-run accident is a fundamental misunderstanding of the coverage. UIM coverage is designed to protect against drivers who have insurance, but whose limits are too low to cover the damages caused. This incorrect advice would leave the client unaware of the true purpose and benefit of UIM coverage in situations involving drivers with inadequate insurance. Professional reasoning. Professionals should approach this scenario by first understanding the client's current policy details, particularly UIM limits. They should then assess the adequacy of these limits by considering factors such as the prevalence of high-limit liability policies in the area and the potential severity of damages in an accident. The next step is to clearly communicate any identified coverage gaps to the client, explaining the risks associated with insufficient UIM coverage. Finally, professionals should recommend specific actions to mitigate these risks, such as increasing UIM limits, while ensuring the client understands the rationale and implications of the proposed changes. This process emphasizes proactive risk identification, clear communication, and tailored advice. Question 16. Investigation of a client's insurance needs reveals a strong desire for the broadest possible coverage across all potential business exposures. The client expresses a willingness to pay a premium for what they perceive as complete peace of mind. Which of the following approaches best aligns with the principles of risk management and insurance and regulatory expectations for property casualty insurance professionals? Option A. Immediately offer the most comprehensive and expensive insurance policy available, as this directly addresses the client's stated desire for maximum coverage. Option B. Advise the client that insurance is designed to cover only specific, defined perils, and that a blanket coverage for all potential exposures is not feasible or compliant. Option C. Conduct a detailed risk assessment to identify specific exposures, their likelihood, and potential severity. Then recommend insurance coverage tailored to address these identified risks. Option D. Focus on selling policies that offer the highest potential for claims payouts, as this demonstrates the value of the insurance to the client. The correct answer is C. Conduct a detailed risk assessment to identify specific exposures, their likelihood, and potential severity, then recommend insurance coverage tailored to address these identified risks. Explanation. This scenario is professionally challenging because it requires an insurance professional to balance the client's immediate desire for comprehensive coverage with the fundamental principles of insurance and regulatory requirements. The challenge lies in identifying and recommending insurance solutions that are not only desired by the client, but are also actuarially sound, ethically justifiable, and compliant with regulatory frameworks governing risk management and property casualty insurance. Careful judgment is required to avoid misrepresenting the purpose and limitations of insurance, which could lead to client dissatisfaction, regulatory scrutiny, and potential financial harm. The correct approach involves a thorough risk assessment that prioritizes identifying and quantifying potential losses before recommending specific insurance products. This aligns with the core principle of insurance, which is to provide financial protection against fortuitous, accidental losses. By focusing on the client's specific exposures and the likelihood and severity of potential claims, the professional can then determine the most appropriate risk treatment option, including insurance. This approach is ethically sound as it ensures the client is not overinsured or sold policies that do not address their actual risks. It is also regulatorily compliant, as it adheres to principles of responsible underwriting and fair treatment of customers, preventing the sale of unnecessary or unsuitable products. An incorrect approach that focuses solely on the client's stated desire for maximum coverage without a preceding risk assessment fails to uphold the principle of indemnity. Insurance is intended to restore the insured to their pre-loss financial position, not to provide a profit or windfall. Recommending excessive coverage without understanding the underlying risks can lead to higher premiums than necessary, potentially making the insurance unaffordable or unsustainable for the client in the long run. This also risks violating regulations that prohibit the sale of insurance products that are not in the best interest of the client. Another incorrect approach that involves immediately offering the most expensive and comprehensive policy available, regardless of the client's specific needs, is ethically problematic and potentially non-compliant. This can be seen as a form of mis-selling, where the focus is on maximizing commission or sales volume rather than providing genuine value and appropriate risk management solutions. Such an approach disregards the principle of insurable interest and the need for a direct relationship between the risk and the coverage provided. Regulatory bodies often have guidelines against such practices to protect consumers from being exploited. A professional decision-making process for similar situations should begin with a comprehensive discovery phase to understand the client's operations, assets, liabilities, and risk tolerance. This should be followed by a systematic risk assessment to identify, analyze, and evaluate potential risks. Based on this assessment, appropriate risk treatment strategies should be developed, which may include risk avoidance, risk reduction, risk transfer insurance, or risk retention. When recommending insurance, the professional must ensure that the coverage is commensurate with the identified risks and that the client fully understands the terms, conditions, exclusions, and limitations of the policy. Transparency and a client-centric approach are paramount to ensure both ethical conduct and regulatory compliance. Question 17. Strategic planning requires an individual to establish a robust framework for managing their personal finances. Considering the principles of personal risk management and property casualty insurance, which of the following approaches to creating and managing a personal budget best supports long-term financial security and effective risk mitigation? Option A. Implementing drastic cuts to all non-essential spending without a clear understanding of income streams or overall financial objectives. Option B. Prioritizing the consistent allocation of funds towards essential financial obligations, including insurance premiums and emergency savings, after accounting for all income and essential living expenses. Option C. Allocating all available income to immediate needs and desires, with no specific provision for unexpected expenses or future financial planning. Option D. Focusing primarily on maximizing discretionary spending and entertainment by deferring payments for insurance policies until they are critically overdue. The correct answer is B. Prioritizing the consistent allocation of funds towards essential financial obligations, including insurance premiums and emergency savings, after accounting for all income and essential living expenses. Explanation: this scenario is professionally challenging because it requires an individual to balance immediate financial needs with long-term financial security, a core principle of personal risk management. The pressure to meet immediate obligations can lead to short-sighted decisions that compromise future financial well-being, potentially impacting their ability to manage risks effectively through adequate insurance coverage or emergency savings. Careful judgment is required to prioritize actions that build a sustainable financial foundation. The correct approach involves a systematic process of tracking income and expenses to identify areas for potential savings and to ensure that essential financial obligations, including insurance premiums, are met consistently. This aligns with the fundamental principles of personal financial management and risk mitigation, emphasizing proactive planning and responsible resource allocation. Regulatory frameworks, while not explicitly dictating budgeting methods, implicitly support such practices by requiring individuals to demonstrate financial responsibility, particularly when seeking credit or managing insured assets. Ethical considerations also mandate that individuals act in their own best financial interest, which includes prudent budgeting. An approach that prioritizes discretionary spending over essential financial obligations, such as insurance premiums, is ethically unsound and creates significant financial risk. This failure to allocate sufficient funds for risk transfer mechanisms like insurance leaves the individual vulnerable to substantial financial losses in the event of an unforeseen incident, directly contradicting the purpose of personal risk management. Another incorrect approach is to ignore irregular or unexpected expenses, assuming they will not occur or can be absorbed without consequence. This demonstrates a lack of foresight and an inability to adapt a budget to real-world financial fluctuations. Such a failure can lead to a cash flow crisis, forcing difficult choices that may include lapsing essential insurance policies, thereby increasing personal risk exposure. Finally, an approach that focuses solely on cutting expenses without a clear understanding of income streams or financial goals is incomplete. While expense reduction is a component of budgeting, it must be integrated with income analysis and goal setting to create a holistic and effective financial plan. Without this broader perspective, the budget may be unsustainable or fail to address the individual's overall financial objectives, including adequate risk management. Professionals should employ a decision-making framework that begins with a comprehensive assessment of the individual's financial situation, including income, expenses, assets, and liabilities. This is followed by the establishment of clear financial goals, which should encompass both short-term needs and long-term objectives, including risk management strategies. The development of a realistic budget, incorporating regular tracking and adjustments, is then paramount. This process ensures that financial decisions are informed, aligned with goals, and ethically sound, promoting both financial stability and effective risk management. Question 18. The monitoring system demonstrates that a significant portion of the walkway leading to the main entrance of a commercial property has developed uneven paving stones, creating a tripping hazard. The property manager is aware of this condition, which has been present for several weeks. A recent visitor has sustained an injury due to tripping on these uneven stones. Which of the following actions, if taken by the property manager, would best align with regulatory compliance and best practices for premises liability? Option A. Document the condition in an internal report but take no immediate action, as the property is not insured against visitor injuries. Option B. Rely on the assumption that visitors will exercise caution and be aware of their surroundings, and wait for a formal complaint or incident report before taking any action. Option C. Advise visitors to use an alternative entrance that is further away and less convenient, without addressing the primary hazard on the main walkway. Option D. Immediately cordon off the hazardous section of the walkway, post clear warning signs indicating the danger, and schedule prompt repair work to rectify the uneven paving stones. The correct answer is D. Immediately cordon off the hazardous section of the walkway, post clear warning signs indicating the danger, and schedule prompt repair work to rectify the uneven paving stones. Explanation. This scenario is professionally challenging because it requires balancing the property owner's right to use their property with their legal obligation to ensure the safety of lawful visitors. The core of premises liability lies in the duty of care owed to different categories of visitors, which varies based on their legal status on the property. A property owner must take reasonable steps to prevent foreseeable harm to those who enter their property. Failure to do so can result in significant legal and financial consequences. The correct approach involves a thorough assessment of the property's condition and the potential hazards present, coupled with an understanding of the legal duties owed to visitors. This includes identifying any dangerous conditions, implementing reasonable measures to warn visitors or rectify the hazards, and maintaining the property in a safe condition. This aligns with the fundamental principles of negligence law and specific premises liability statutes that mandate property owners to act as a reasonably prudent person would under similar circumstances to prevent injury. The regulatory framework emphasizes proactive risk management and adherence to established safety standards to mitigate liability. An incorrect approach that fails to adequately inspect the property for hazards or implement necessary safety measures demonstrates a breach of the duty of care. This could lead to liability for injuries sustained by visitors, as the owner has not taken reasonable steps to protect them from foreseeable risks. Another incorrect approach might involve assuming that all visitors are aware of potential dangers, without providing adequate warnings or safeguards, which disregards the legal requirement to inform visitors of known or discoverable hazards. Furthermore, ignoring reported issues or failing to address them promptly constitutes negligence, as it shows a lack of reasonable diligence in maintaining a safe environment. These failures directly contravene the legal and ethical obligations of a property owner to ensure the safety of those on their premises. Professionals should employ a decision-making framework that begins with understanding the specific legal duties applicable to their jurisdiction regarding premises liability. This involves identifying the types of visitors expected and the corresponding duty of care owed to each. The next step is a comprehensive risk assessment of the property, identifying potential hazards and evaluating their severity and likelihood of causing harm. Based on this assessment, appropriate risk control measures should be implemented, including warnings, repairs, or removal of hazards. Regular inspections and maintenance are crucial to ensure ongoing safety. Finally, maintaining thorough records of inspections, maintenance, and any incidents is vital for demonstrating due diligence and managing potential claims. Question 19. The review process indicates that an insurance agent is evaluating premium adjustments for several clients. Which of the following approaches best aligns with regulatory requirements and ethical best practices for factors affecting auto insurance premiums? Option A. Applying a standard premium increase for all clients within a specific age bracket, regardless of their individual driving history or vehicle. Option B. Significantly increasing premiums for clients residing in certain urban zip codes based on general assumptions about crime rates, without specific actuarial data for those zip codes. Option C. Automatically assigning a higher premium to clients driving sports cars, even if they have an impeccable driving record. Option D. Adjusting premiums based on a comprehensive assessment of each client's driving record, age, vehicle type, and specific geographic location, using approved rating factors. The correct answer is D. Adjusting premiums based on a comprehensive assessment of each client's driving record, age, vehicle type, and specific geographic location, using approved rating factors. Explanation. This scenario is professionally challenging because it requires an insurance agent to balance the need to accurately assess risk for premium calculation with the ethical obligation to treat all clients fairly and avoid discriminatory practices. The agent must understand how various factors legitimately influence insurance costs without resorting to generalizations or biases that could lead to unfair pricing. Careful judgment is required to ensure that premium adjustments are based on established risk factors as permitted by regulations, not on personal assumptions or stereotypes. The correct approach involves a thorough and individualized assessment of each client's profile against established underwriting guidelines. This means considering the driving record, age, vehicle type, and geographic location as legitimate risk indicators that directly impact the probability of claims. For example, a history of accidents or traffic violations, driving record, directly correlates with a higher likelihood of future claims. Younger drivers or those in certain age brackets often face higher premiums due to statistical data indicating increased risk. The type of vehicle, such as a sports car versus a family sedan, can influence repair costs and theft risk. Finally, the location of the insured, particularly urban areas with higher rates of theft and accidents, is a recognized factor in premium determination. This approach is ethically sound and legally compliant because it adheres to the principle of risk-based pricing, which is fundamental to insurance underwriting, and is permitted by regulatory frameworks designed to ensure solvency and fair competition. It avoids arbitrary or discriminatory pricing by focusing on objective, statistically validated risk factors. An incorrect approach would be to apply blanket premium increases based solely on a client's age group without considering their individual driving history or vehicle type. This fails to acknowledge that not all individuals within an age demographic represent the same level of risk. Ethically, this is unfair as it penalizes responsible drivers. Legally, it could be considered discriminatory if it violates specific state or federal anti-discrimination laws that prohibit pricing based on protected characteristics, or if it deviates from approved rating factors without justification. Another incorrect approach would be to significantly increase premiums for a client living in a particular neighborhood without a clear, data-driven justification for that specific location's elevated risk beyond general assumptions. While location is a valid factor, the increase must be demonstrably linked to statistically higher claims frequencies or severity in that precise area, as supported by actuarial data. Failing to do so can lead to accusations of redlining or unfair discrimination. A third incorrect approach would be to dismiss a client's clean driving record because they drive a high-performance vehicle, automatically assigning a higher premium based solely on the vehicle type. While vehicle type is a factor, a pristine driving record significantly mitigates the risk associated with a performance car. Ignoring this mitigating factor and solely focusing on the vehicle type demonstrates a failure to conduct a comprehensive risk assessment, potentially leading to an unfairly high premium and a breach of ethical duty to the client. Professionals should employ a decision-making framework that prioritizes data-driven underwriting and adherence to regulatory guidelines. This involves 1. Understanding and applying approved rating factors, driving record, age, vehicle type, location, as defined by the relevant jurisdiction's insurance department. 2. Conducting individualized assessments for each client, recognizing that these factors interact and should not be applied in isolation or with undue weight. 3. Maintaining transparency with clients about how their premiums are determined. 4. Regularly reviewing underwriting guidelines and regulatory updates to ensure compliance and ethical practice. Question 20. Stakeholder feedback indicates a need for clearer guidance on how to advise insureds when a guest sustains an injury on their property due to a visible hazard. Specifically, how should an insurance professional best explain the interplay between personal liability and medical payments to others' coverage in such a situation? Option A. State that personal liability coverage will automatically cover all costs associated with the guest's injury, and medical payments to others' coverage is redundant in this scenario. Option B. Explain that personal liability coverage will respond if the insured is found legally liable for the guest's injury, and medical payments to others' coverage can provide prompt, no-fault payment for the guest's medical expenses up to the policy limit, regardless of fault. Option C. Advise the insured that only medical payments to others' coverage is relevant, as it is designed for guest injuries on the property, and personal liability is for more severe incidents. Option D. Inform the insured that they should handle all medical expenses for the guest themselves, as the homeowner's policy is unlikely to cover such incidents. The correct answer is B. Explain that personal liability coverage will respond if the insured is found legally liable for the guest's injury, and medical payments to others' coverage can provide prompt, no-fault payment for the guest's medical expenses up to the policy limit, regardless of fault. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an insurance professional to interpret and apply the nuances of homeowners' liability coverage in a situation that could have significant financial and legal ramifications for both the insured and the injured party. The professional must balance the contractual obligations of the policy with the ethical duty to provide accurate and helpful guidance, ensuring the insured understands their coverage and the insurer fulfills its responsibilities. Misinterpreting the scope of personal liability or medical payments coverage can lead to underinsurance, denied claims, or even legal disputes. Correct approach analysis. The correct approach involves accurately identifying the nature of the incident and determining which specific coverage within the homeowner's policy is most applicable. Personal liability coverage is designed to protect the insured against claims for bodily injury or property damage caused to others for which the insured is legally liable. Medical payments to others coverage, on the other hand, is a no-fault coverage that pays for reasonable medical expenses incurred by a guest who is injured on the insured's property, regardless of fault. In this scenario, since the guest's injury was a direct result of a condition on the insured's property, and the insured is likely to be found legally liable, both coverages may be relevant, but the initial assessment should focus on the primary cause and potential liability. The professional must explain to the insured that the incident likely triggers the personal liability section of their policy, which would respond to claims for damages if the insured is found negligent. They should also inform the insured about the medical payments to others coverage, explaining its no-fault nature and its potential to cover immediate medical expenses for the injured guest, irrespective of a formal liability determination. This dual explanation ensures the insured is aware of all potential avenues of coverage and the insurer's obligations. Incorrect approach is analysis. An approach that focuses solely on medical payments to others coverage without acknowledging the potential for personal liability is incorrect because it fails to fully inform the insured about the extent of their protection. While medical payments may cover initial expenses, it has a lower limit and does not address potential future damages or pain and suffering if the insured is found legally liable. This incomplete advice could leave the insured exposed to significant financial risk if the guest's injuries are severe and result in a lawsuit. An approach that immediately denies any coverage based on a preliminary assumption of no fault is also incorrect. Homeowners' liability coverage is broad and designed to protect against unforeseen events. A thorough investigation is required to determine fault and the applicability of coverage. Premature denial without proper assessment violates the insurer's duty to investigate claims and can lead to bad faith allegations. An approach that suggests the insured should handle the matter entirely independently without involving the insurer is incorrect and potentially harmful. Policy contract obligates the insurer to defend the insured against covered claims and to indemnify them for covered losses. By advising the insured to forego this protection, the professional is failing to uphold the terms of the insurance contract and is not acting in the best interest of the insured. Professional reasoning. Professionals should adopt a systematic approach when faced with a potential liability claim. First, they must gather all relevant facts about the incident. Second, they should consult the specific policy language to understand the definitions and exclusions related to personal liability and medical payments. Third, they must explain the potential applicability of each coverage to the insured, clearly differentiating between fault-based liability and no-fault medical payments. Fourth, they should advise the insured on the proper claims reporting procedures and their obligations under the policy. Finally, they must ensure that all communications are clear, accurate, and documented, reflecting a commitment to both contractual obligations and ethical client service.